Hey everyone, Douglas here, and welcome back to the channel. In this video, we are going to do something a little bit different than we normally do on this channel, and we're going to dip our toes into a little data science, a little machine learning, and we're going to take a look at a handful of variables and how they compare to CPI in an attempt to try and understand of the kind of the main factors that most people would think are correlated with CPI. What might be the main driver of CPI? So that's what we're going to try and figure out. And the reason that we're doing this is to really better understand what information is being told to us relative to CPI, or if CPI as our target, what information is being told to us about CPI by any of the main variables that again, I think most people would conclude, no matter what school of economics you're from, would give us the most amount of information, and then particularly be the driver, kind of the cause of inflation. And we'll get into those definitions a little bit more deeply, especially if you're into machine learning, you're into data science, data analysis. You'll understand that there needs to be some big caveats placed on that. But that is our goal for tonight, and that is what I have pulled up on the screen. And so, yeah, we're going to dive into the Jupyter notebook that I put together that did all this. And if you're not familiar with Python, don't worry. I'll walk you through any of the code and what needs to be understood as we go along. But I think this is interesting, and I think this is going to be really helpful. And the reason that we would do this, the main reason that we would do this, or at least the next step to why data scientists would do steps like these, is really to understand the variables you're working with, what sort of predictability they would have on other variables. So ultimately, when you stick these variables into a deep learning model, you'll have the model learning what it is that it's supposed to learn, and that what it spits out in the learning process is intelligible because we have the right starting place with what variables are causing which variables, and if that sequence is the other way around. We want to know that, right? So we want to know what we're dealing with from a statistical standpoint. So when we piece these together in a larger learning model, we know what the model is actually learning on. So let's get into things. Before we dive into the details, if you are new here, make sure you hit subscribe, turn that notification bell on as well. And if you find this video particularly helpful, make sure you give it a thumbs up on the way out. So like I said, Jupyter Notebook pulled up, and already you can see I pulled in 6 variables here to take a look at how they look relative to our target variable of CPI. So I have government spending in the top left here. I have oil inventory. So government spending, of course, is well known. What this actually is the percent change year over year of the accumulation of spending via the monthly treasury statement. I have oil inventory, and this is the comparative inventory model that I use to essentially be the supply side test out of everything. I have the 10-year yield. Self-explanatory. I have M2. This is a common variable that many monetarists will say is a key driver in inflation. I have deposits, which would be kind of a subset of M2, is a bit of a I don't want to call it a baseline, but it's a bit of we should see some correlation between M2 and deposits. And then finally, I have the Fed funds rate, which again we would expect to be not too far away from where the 10-year yield is, and a bit of a driver of that. So these are all the variables. From an MMT perspective, one of the things that MMT is aware of is what the interest rate does to inflation, right? So from an MMT perspective, it's the interest rate, the higher interest rate, or really the acceleration of the interest rate, that can drive inflation and keep inflation essentially perpetuating for really multiple reasons. But the two main ones are going to be that term structure of prices, right? The future cost of doing business increases. And then on top of that, higher interest rates also mean more interest income to the private sector. Those interest rates get pushed higher, that the government has to pay out on those bonds. So MMT would see the 10-year yield, or at least yields itself, as a potential driver of inflation. Obviously, oil inventory, MMT would see supply is usually probably the main cause of what we would see as inflation, and then government spending as well. Again, a monetarist interpretation of what might be driving inflation. So we're going to break these down. We're going to see what they tell us about inflation using mutual information. And then we'll see if granger causality gives us any insights into the forecasting ability of any of these variables. So just to show everyone what the setup is here, I loaded 2 data frames. If you're unfamiliar with Python, a data frame, just think of a data frame is Python's version of an Excel worksheet. I imported 2 of them, a normalized data set and the complete data set, which then gave us the chart that we were looking at below. There's a handful of other variables on here. You'll see why those are important when we push a little bit lower, but that is the data frame. And then one of the things we're going to have to do is normalize this data frame, and you'll see that down the line as well before granger causality can be done. But here is the mutual information graph that we have that explains the mutual information between each variable and the target variable of CPI. So what is mutual information? Mutual information is a measure of the amount of information that one random variable, so in this case Fed funds, 10-year yield, government spending, oil inventory, M2 deposits, and my average local temperature, what that variable contains about another, and in this case it's going to be CPI, and it's going to quantify the amount of dependency between those 2 variables, or essentially compare the usefulness of these different variables or these features for predicting what's ultimately going to be our target variable, or CPI. In other words, this is just another look that gives us a slightly better picture, especially when you're dealing with economic data, than something like a Pearson correlation. So the Pearson correlation is going to assume a linear relationship, whereas mutual information is going to measure the dependency between the variables. And I think that's an important aspect, or an important angle to look at this from, is not just necessarily what is the linear relationship, because when you look down at our chart, each one of these variables is clearly correlated to some extent with CPI, and probably doesn't really take much of a PhD in statistics to realize that. And so once it passes the eye test, what we really want to do is understand, okay, is there enough amount of information being passed on from essentially the random variable, or our Fed funds, 10-year, et cetera, to CPI to continue on to even the next step? And what we see is, for each one of these, there's definitely a high enough amount of mutual information to let us know that, there's something happening here between these variables. They are useful for understanding one another. You can see the baseline that I have here as our average, or as my average local temperature, barely registering on the Richter scale, so to speak, and then everything else flying high after that. And the other thing too is, let's just say my average local temp measured at 0.1. If the next variable measured at 0.2, we can say that that's telling us double the amount of information, right? And if it were to be 0.3, that would be triple the amount of information. So what this is saying is, with M2 and deposits, let's just say it's right at 0.5 and Fed funds at 1, that Fed funds is telling us double the amount of information than what M2 and deposits are telling us. But all of these definitely fit in the category of variables that are giving us information about our target variable, CPI. But what these aren't doing is they're not in any way giving us a statistical understanding of what the usefulness would be for forecasting that time series. At this point, we don't know what direction this information is being given, but that there is information there to be gained, and that is where granger causality happens. So, long story short, we can definitely say with CPI, with inflation, all of our target variables are definitely giving us information, and there's a reason that these all correlate on a chart. But can we find out which one granger causes the other, right? Which one is going to be used for, or is going to be most useful for forecasting CPI? And of course, this is going to be important to grab those variables if we put them in some sort of learning model where we are going to want to forecast CPI, because if granger causality tells us that in fact CPI is forecasting that variable, right? CPI is leading that variable, and we teach the learning model that it's the opposite, we're going to get out pretty useless response from our deep learning models. So let's scroll down and take a look at our Granger cause. The first step we have to do, and this is an important step, and certainly if the data science people are watching this, they're going to want to make sure that this step was taken. But we do want to normalize the data, right? We want to make sure that the data is what's called stationary. So we want to make sure it has a constant mean, constant standard deviation, and that the seasonality is removed. And that's a step that's necessary just for Granger cause. When you normalize data for deep learning models, you're not necessarily going to remove the especially if you're running like a LSTM model, you're not going to remove that seasonality, but you do need to normalize the data, removing stationarity for Granger cause to be most effective. And then we're finally going to run our Granger cause test. Now in Python, it's pretty darn simple. You just create your variable, run the Granger call or call the Granger call test package, and put in your variables. And how to read this, and I'll go ahead and zoom on in here. How to read this is you'd read this as, does government spending Granger cause CPI? And then what you're looking for is the p-value that gets returned at each time lag. So you can see I put in 12 time lags up here, and then at each time lag, is the p-value below 0.05, because the way that you actually read this, because some statistic geek made the Granger causality test, and then they're right to do this, but the way you would actually read this is kind of as a double negative, that your null hypothesis would be that CPI does not cause government spending. And so if you have a p-value of less than 0.05, then you would say that CPI does not cause government spending. And so that's how you'd end up reading this. But the easy way to read it is, does government spending cause Granger cause? And again, to be clear, Granger cause is a statistical concept that's used to determine if one time series is useful for forecasting another time series. It's not answering that philosophical question of what causes the next thing. It is just simply giving us the statistical usefulness of forecasting one variable for the next. And in this case, with government spending and CPI, we never get a break below the 0.05 value that would be necessary to say that government spending Granger causes CPI. So we can go ahead and reject government spending as being a Granger cause of CPI. Now, the CPI Granger cause government spending. Why would we even think this? Well, maybe inflation is really, or government spending is really a function of CPI suddenly taking off, right? Maybe that is what is actually taking place. And to a certain extent, I actually think from a theoretical level, that is really what it is. The inflation is there, right? You get the supply chain shock. It's how the government responds that is how that inflation that is already there responds. But we see over the time period that we ran this test, so this is going all the way back to the 1990s, so over 30 years, actually all the way back to I think it was the mid to late 80s, over 30 years worth of data. Over that time frame, CPI doesn't Granger cause government spending either. And again, I did run these for 12 time lags, only for display in the notebook itself, but I did check the other time lags. Next up, does M2 cause Granger cause CPI? And the answer is no. Again, we're looking at these p-values, never cross below 0.05. And don't get kind of pulled into this idea that if it's at 0.06, maybe that's close enough. That's not exactly how these tests work. You set your p-value ahead of time, and you say that at 0.05, that we would reject the null hypothesis only if it was below 0.05. So again, we don't get that for M2 Granger causing CPI. Then the next question is, do we get the opposite to occur with CPI Granger cause M2? And generally speaking, so we do finally get our first p-value that's below 0.05. And generally speaking, you need two of the lags to go ahead and Granger cause, or have a positive Granger cause, affirmative Granger cause, and not including just the first time lag. And in this case, we don't really get that. So we're going to go ahead and say that CPI does not Granger cause M2 either, and we'll move along. Now, does CPI Granger cause Fed funds? That's the next up in our list, and we're going to go ahead and say it does not. And then scrolling down, we're going to ask if Fed funds Granger causes CPI, and it does not either. So far, we're not seeing any Granger cause being affirmed here in any of our variables, but that will change in just a second. So one of the things that I did pull in here, because I was a little suspicious of the Granger causality between CPI and Fed funds, is I did take a look at the rate of change of Fed funds, because it does make sense to me that it's really kind of that acceleration, that sudden push of Fed funds that might be causing CPI or vice versa, because with Fed funds, you're also having the Fed looking out at the market, making a determination if they want to raise rates. So even if rates cause inflation, well, it could be that inflation that begins to materialize that is going to affect the Fed. So I did want to see both directions if we end up seeing a Granger cause being confirmed with a percent change. And for the first time, we do see that CPI will cause the Fed funds rate, that the null hypothesis failed. And so we can say that the CPI Granger cause is the Fed fund rate at the rate of change level. But what we do need to do is look at it in the opposite direction as well. And if the opposite direction is at an even lower p-value, then we can actually say that, nope, it's the other way around. Oftentimes you'll see both variables get confirmed for Granger cause, and we need to check. And lo and behold, we don't get that. So what we can definitely say is that it looks like the Fed fund, or the Fed is looking at CPI, at the inflation data that's coming in, and then making their decision based on that CPI. That makes sense that the Fed funds rate would actually do that. What'll be interesting to see is when we get down to the 10-year yield, if that stays, or if the market gets ahead of the Fed and therefore gets ahead of inflation, and therefore actually causes that inflation because, or Granger causes that inflation because they are anticipating that inflation coming, and then kind of a self-fulfilling prophecy, pushing inflation higher with those higher rates, consistent with what we'd expect with an MMT worldview. So, does CPI Granger cause the 10-year yield? The answer is nope. We don't have an affirmative there. Does the 10-year yield Granger cause CPI? And it does look like it. This is the neat one. I mean, it does look like it, that the 10-year yield Granger causes at the fourth time lag CPI. So let's dig a little deeper. Let's see, does that rate of change also hold up? Rate of change of the 10-year yield, the CPI cause the rate of change of of the 10-year yield. And yeah, it does look like we have that, but we need to look also at the 10-year yield Granger causing CPI, and what you'll see is the p-values are much lower. So it definitely seems like, at least again, for the forecastability purposes, the 10-year yield is going to be, at this point, out of all of our variables, the most effective for forecasting CPI. And again, if we're going to put this into our learning models, it's that 10-year yield that would be kind of the dog, and the CPI being the tail here in terms of who's wagging who at this point. Next up, we're going to take a look at CPI with deposits. Does CPI cause deposits? And this was one of the ones that I threw in there as, again, just as a bit of a, I don't want to call it a baseline, but it was just a bit just to see how it did relative to M2, since I knew M2 was one part deposits. And it is kind of interesting when you look at deposits. So if loans create deposits, all of a sudden you see CPI leading or being a Granger cause of deposits. And I think this kind of makes sense, because as inflation starts hitting, what do we end up seeing? We see people needing to go to their credit cards. And again, this is not just over the 2020-2021 period, but this is over the last 30 some odd years of the data during this test. So that was kind of an interesting finding that I didn't necessarily expect. And then, do deposits cause CPI? We do not get that effect to confirm. So it definitely looks like CPI has an effect on deposits. We expect deposits to take off. I think the knock-on effects, the knock-on implications are pretty deep there, a little more than what this video can go into, but definitely get the juices flowing and think that through, what the implication might be. Again, if loans create the deposits, what that actually means of what inflation is actually doing to the kind of financial structure of the banks who would be making those loans. So yeah, a little homework as you go away from this video to think through. All right, next up, we're going to take a look at CPI. Granger causing oil inventory, as you'd expect. This is not the way that it works. And then we're going to look at oil inventory, Granger causing CPI. And again, this would be kind of an MMT assumption here. Oil inventory being kind of a supply side measure, and lo and behold, we do see at 1 and 2 time lags, we get the affirmative here, and so we can say that oil inventory does Granger cause CPI. So that was all the tests that we ran, and we found out that it looks like that inventory, supply side, and the 10-year yield accelerating seem to be the drivers of inflation, or at least what we would call, or what we'd say again, the time series that are most useful for forecasting CPI, and that CPI is going to be most useful for forecasting deposits. Otherwise, there's not a lot that we can say in terms of the forecastability between all of these variables. So I would say this very much fits in and kind of confirms the MMT view. Couple surprises in there, but nothing too outlandish. Certainly nothing that MMT as a framework wouldn't expect, and it seems to again kind of confirm what it is that MMT would anticipate seeing. And I particularly like that takeaway, and certainly a homework project for us all to go back with the CPI Granger causing deposits and think that one through and see if there's anything there. So that is the research that I have to share with you tonight. And hopefully you found this useful. Let me know down in the comment section below what your thoughts were, and if there's anything else that you would like me to kind of put the time into studying in terms of macroeconomics. But this is something that I'll be sharing a lot more of in the coming future. We have some really cool learning models, deep learning models that we put together and are continuing to develop that we'll be sharing soon. And these are just the steps that we're taking. So I thought I'd share it and kind of let it be what it is and get your feedback and go from there. So yeah, I'm going to go ahead and wrap up this video here. Again, like, subscribe, turn the notification bell on, check out the Patreon if you're an active trader, active investor, and this sort of information paired with learning models would help you with your trading, investing. Make sure you check us out over on the Patreon page, patreon.com/MMT macro trader. There is a link in the description below. Otherwise, I'm going to wrap it up here. So until next time, good trading, everyone, and we will talk to you then. Bye-bye.